Hello students, today we are going to study the next unit of macroeconomics class 12 portion, that is money. This unit is consisting of two chapters, money, and the next chapter is the central bank and the functions of commercial banks. So let us start with the meaning of money. Money is something which revolves around the economy. A whole economic system, we can say, is possible because of money only. In old times, when money was not evolved, that time barter system was going on. So to learn the definition of money, first it is important to understand the meaning of barter system. So let us start with the explanation of barter system. Barter system refers to exchange of goods for goods. An economy where there is a direct barter of goods and services is called as a barter economy. So barter system was working very good and it continued for many years. For example, a farmer gives wheat and get clothes from the weaver in return. It means that goods are exchanged for goods. But simultaneously, when the mutual wants of buyers and sellers were unable to get coincide, the limitations of barter systems emerged, and let us see what were the limitations of this barter system. First and foremost, lack of common measure of value. It means that there was no common measure of value of goods and services in which exchange ratios can be expressed. What I mean to say is, suppose if A has rice and B has wheat, then it is difficult to decide how much wheat is needed to exchange with 1 kilogram of rice. It means that common measure of value of wheat in ratio to rice cannot be expressed or cannot be fixed. It was that time fixed very randomly. So it was depending 100% on the demand of the customer. If the demand of the person having the rice was more than that of the demand of B having wheat, then the ratio was fixed accordingly, which was not at all fair. Second, there was lack of double coincidence of wants. It means that suppose A want to exchange goods with B only when A has what B wants and B has what A wants. However, if such double coincidence is not arising, then it was not possible to exchange the goods. So every time it was happening, that double coincidence was very rare, and this was one of the limitation. Third limitation is there was absence of means of subdivision. Subdivision here means if a person is, suppose A, he is having 10 kg of rice and B on the other hand want to sell his horse which he was having, the only asset, but he is not having anything else to sell. So if horse can be exchanged with 10 kg of rice, then it will not be fair because the value of horse is very high. But as there was no subdivision system, the subdivision of all the goods is not possible. This is the reason this limitation also arises. Next is lack of store of value. Under barter system, it is difficult for people to store wealth for future use because there were many goods which are perishable. They do not possess the durability and their quality deteriorates with passage of time. Moreover, the storage of goods requires time and effort. Like nowadays, warehouses are maintained, but that time that system, that technology was not there, so that goods can be stored at a good time and for more a number of days. As a result, good cannot be used to store the earnings for a long period. But when we compare it with that of money, it is very natural that we can save the money for many years. Last but not the least, the limitation of barter system is lack of standard of deferred payment. It means that if there is contract that for future use or for future payments or credit transactions, nowadays as it is happening usually, that time it was not possible with ease because the borrower may not be able to arrange goods of exactly same quality at the time of repayment, or there may be conflicts regarding which specific commodity is to be used for repayment. The commodity to be repaid may lose or gain its value at the time of repayment. So, it is very difficult to make deferred payments. Deferred payments means future payments, that is selling of goods and services on credit. This was also not possible. So, now we have understood what is barter system and what are the limitations of barter system. Now, let us proceed towards our core topic, which is money. The definition of money is anything which is generally acceptable as medium of exchange, measure of value, store of value and means of or standard for deferred payment. Here we can see that all the deficiencies of barter system has been eliminated by money. So, this is important to understand that all the limitations of barter system are now becoming the functions of money. All the 4 points written in red, medium of exchange, measure of value, store of value and means for standard of deferred payment. All these were the deficiencies of barter system which I have shown you, and these are actually the functions of money. As we can say that money has recovered all the deficiencies of barter system. The next part of the chapter is money supply. Money supply. Money supply is total volume of money held by public at a particular point of time. It is specifically mentioning that it is point of time. It means it is a stock concept and not the flow concept. We have already studied the difference between stock and flow concept, and stock concept always measures at a particular point of time, means measurement of the value is possible anytime. So, money supply is total volume of money held by public at a particular point of time and in an economy. Since 1977, there are 4 alternative measures of money supply which can be explained as M1, M2, M3 and M4. There are little variations amongst all these because the content of all these are somewhat different. Let us see what are the measures of money supply. First is M1. M1 includes currency and coins held with public plus demand deposits with commercial banks plus other deposits with RBI. First, let us understand the first point, that is currency and coins held with public. Currency and coins held with public are the paper notes and the coins of various denominations. The coins of denominations like 10, 5, 2, 1, etc. as it is ordered by the government, and paper notes are 2000, 500, then 100, 50, 20, etc. that is 10 as it is ordered by the government. As the follow up of the government order is always present, this is the reason this currency and coins held with public is also known as fiat money or the legal tender money. Fiat money because it is under the order of the government to act as the money supply. It means that, moreover, legal tender money, it means that for all kind of debts, it will be acceptable in the country. Second point is demand deposits with commercial banks. Demand deposits with commercial banks means all such kind of deposits which are made by public in the banks, but they are easily checkable. Checkable means can be demanded anytime. The check will be issued by the check will be presented or issued by the person who is having that money in his bank account, and the same can be withdrawn from the bank. So it is called as demand deposits, means the deposit is made in the commercial bank but can be demanded anytime by the customer. Moreover, here I will explain you that there are two kinds of deposits in the bank. First is the demand deposit, and second that is with the public, made by the public. But second one is the demand deposits of the bank. It means that interbank transactions are also held, and one bank can keep deposit of other bank in its account. So we are required to exclude that interbank deposits. So it means that this demand deposit is actually the net demand deposit with commercial bank, and it is excluding the interbank deposits. Third is other deposits with RBI. There are many such deposits which RBI hold on behalf of other governments, or we can say on behalf of the financial institutions, or on behalf of the general public. So these are those deposits which are included in other deposits of RBI. That is point number 3. Second measure of money supply is M2. M2 means M1 plus saving deposits with post office saving bank. It means that we are including all the three contents of M1 and we are including saving deposits with post office. Now a question arises, why this was, as it is also a saving deposit, why it is not included here? Because this is not at all checkable, and the public or the person who is having this deposit in the post office, that is in the saving account and cannot be demanded at any time. This is the reason it is not included in M1. So the scope of M1 is narrow as compared to that of M2. In M2 we are including these deposits also, which are the saving deposits and cannot be asked through the checks. Third is M3. M3 means M1 plus net time deposits with bank. Net time deposits with banks means deposits are again of three kinds. First is the person who is having current deposits, which are checkable and general transactions of business take place through that. Second deposits are the deposits in the accounts, that is saving accounts of the people, which are checkable again and can be demanded anytime. But there is one more kind of deposit which is called as time deposit, also called as FDs, that is fixed deposits. It can be demanded after a particular period of time, that is a period is mentioned where interest rate is also high and people used to keep the money for a long time in the banks, for which they are able to avail more interest. So this net time deposits with banks are again included. So the scope of M3 is again broader than that of M1. But see, there is difference in M2 and M3. In both of these, M1 is included, but the second content is different. Then last but not the least is the M4. M4 means M1 plus net time deposits with bank plus total deposits with post office saving bank, but it does not include national savings certificates. So this is having the most broader concept. We can say it is like a pyramid. The scope of M1 is narrow, and as we are going down, the scope is increasing, that is becoming broader. Now it is important to mention here that M1 and M2 are having narrow scope as compared to M3. So in general course of business, we use M3 as the measure of money supply in the economy. So I hope the concept of money and why it is evolved is now clear. With this, we conclude this chapter. Thank you.